Welcome to the first part of a multi-part series on day trading. In this series, I'm going to cover basics of the stock market, tips and tricks on how to negotiate timelines and establish patterns, as well as money management. So, Intro into Day Trading by Matthew, that's me. I'm not licensed, these are just my opinions. Trade at your own risk, do your own research, and I am not sponsored. One of the resources I'll be using for this video and for the whole series is this book right here, A Beginner's Guide to Day Trading Online by Tony Turner. It's a good book, I recommend picking it up if you want to follow along. It's got a lot of good material in it, and it's broken down so that anybody can understand it. I'm going to start off this video with a quote by Tony Turner. "Welcome to the wild, wild world of day trading. Hang on tight, because if you jump aboard, it will be the most exhilarating and most terrifying ride you'll ever take. Keep that in mind." First thing I'm going to cover is chapter 1 of the book. This is just a rough example that I drew out for when I go over emotional trading. Day trading is a made-to-order profession. By and large, you can work when and wherever you want. You can think of it as a small business. Invest in a good computer, internet, and whatever trading platform you will use. So, key things to take away right there: a good computer or cell phone if you're trading from your phone, fast internet, and picking a platform that's good for you. In addition, you can live wherever you want. There's no set place in which you must day trade from. You can trade from your room, from your house, multiple houses, whatever you prefer. As an active trader, you're independent and answer to no one but yourself. Keep that in mind, because you are your own boss in this, so it requires discipline. Know this: Wall Street takes no prisoners. The trading highway is littered with wrecks. Trading is the most dangerous human endeavor, short of war. Here's another reality statement: 80% of those who try quit. The best way to start trading is slowly, calmly, and armed with knowledge. So do not start trading until you have established a good wealth of knowledge, and don't take it too fast. Paper trading is where you should start, at least for a few weeks until you feel comfortable in trading. It's a good practice. Just know that real trades may not play out the same way as in paper trading, because the market fluctuates, things happen. It's really unpredictable. Successful traders have 3 qualities: brains, bucks, and boldness. So you have to be smart enough to know what you're doing. You have to have the money in order to make money, because you spend money to make money. And you have to be able to take risks, calculated risks. Emotional discipline is a must. You will lose money, all right? That's a fact. You're going to lose money. Get over it, because you're going to make money as well. Just calculate those risks. Have your profit be larger than your deficit. Take a break and figure out what happened. So when you lose money, examine why you lost money. Maybe you entered a trade in the wrong spot. Maybe you didn't set a stop loss. Something like that. It's the simple mistakes that will cost you, to lose money. Learn from your mistakes. Learn from your positive trades and what you did correctly. That way you can do that for the next trade. There are 2 emotions you will face on a daily basis: greed and fear. They will be your closest companions. So, here we go into emotional trading. I made this little diagram right here. This right here just represents kind of a graph for how a stock did in a certain day. You have time on the bottom right here, you have price over here. So emotions come into play when you are trading in stocks. No matter what you're doing, no matter how much control you have, that's just a fact. So this is an example of greed. Greed takes place when you start making money and you keep wanting to make money even though you're unsure of things, or you just want to keep that flow going. But you have to take a tactical pause and allow yourself to think rationally. So here's a good example. So you bought in right here, okay? The stock starts going down, and you think to yourself, oh, it'll go up because they're building a new factory, right? So you keep your position. Now, this person should have set a stop loss because, as you can see, they held out basically until the bitter end. And I'll go into a stop loss. I'll go into a stop loss in a later video. So this person held on to their position, and now it continues to fall. And they're thinking to themselves, oh, okay, we're going to run out of oil, and basically we're going to switch to solar and batteries because they are the future. So this is probably some kind of tech stock or like a commodity stock. Anyway, it keeps on going down. And now he's thinking to himself, the price is at a previous support, which I'll go into that in a later video as well. So a bounce is likely. I'll go into what a bounce is later on as well. Anyway, this person continues to keep their position. Stock plummets drastically, and they go off of something that they heard on Twitter. He said that he saw people on Twitter saying to hold it for the long run. And I'll go into why that's bad later on. Alright. In a bull market, stocks explode in direct proportions. With that being said, greed runs rampant. That's an example of a bull market right there. Just know the danger, what goes up must come down. When it does, fear runs rampant and the bears come out. A bull market is a market on the rise and typically economically sound. A bear market, right here, is a market that is receding where most stocks are declining in value. As you can see right here, going down, downward trend, upward trend. Price is the bottom line. The most important aspect of the stock market is price, price, price. For every transaction in the stock market, there's a buyer and seller. The buyer and seller agree on a price to make an exchange. The buyer has hopes for the stock as he or she has done their research, so they are in position about it. The seller is more than happy to get rid of the stock as they think the stock is going to go down in value. Therefore, they sell it. Don't mind me, I'm just flipping through my script. Why do prices go up or down? They move because of supply and demand, generated by greed and fear. Where do you come into the stock market? There are two paths you can take: directing your order to an online broker, or executing your order through a direct access trading platform. So say you want to buy one share of Boeing, symbol BA, at the market, which is the current post price. Your order can be filled in one of two ways. One, you call your broker and give your broker the order, or you can bring up your online account and send the order to your broker via the internet. When the broker receives the order, he electronically directs it to a specialist or a market maker at the target exchange, where the stock is being traded. Once your order is filled, your broker is notified of the fill. Basically, what a fill is, it's a precise number of shares at a certain price point that they are to be filled at, or basically executed. He then sends you a confirmation. This can take seconds to minutes. 2, you can execute the order yourself through a direct access broker from a NASDAQ level 2 screen system. Basically, I'll go into that in a little bit. Your order goes directly to an exchange or market maker, and once filled, you will see an instantaneous confirmation. Basically, what a level 2 screen is, it offers transparency on quotes. That means that you can see bids and asks from nearly all the current market positions, posting buy and sell orders, not just the inside bid or inside ask. Now I'm going to go into what a bid and ask is. So as you can see here, I have a little diagram of what a screen might look like for you. This is a level 1 screen because it only has the current inside bid and inside ask. A level 2 screen is going to look way more complicated because it's going to have an order book going down through this whole thing right here. The bid, the ask, and the offer. When you jump online to your account and request a quote, let's say for example, Oracle Corporation, a ticker symbol ORCL, the quote will display as something like bid $13.78, ask $13.79. So right here I've pulled up Microsoft Corporation. It has a bid of $46.39 and an asking price of $46.40. This means that at $13.78 or at $46.39, the inside bid or the highest price you can demand if you want to sell ORCL, or in this case Microsoft, as a market order. So the bid is the highest price that you can sell the stock for. And if you think about it, the ask is the highest price that you can buy the stock for. The minimum price. The spread is the 1 cent difference between the two prices. So the spread here, it's like right there, basically. When you get a quote from the exchange, whether verbal or written, the bid is always announced first, and then the ask is offered second. These are known as level 1 quotes. So bid is first, ask is second. This is a level 1 quote. All right. The NASDAQ level 2 system. Basically, it just covers all activity on traded stocks on all exchanges, and as I said before, it offers transparency. So basically you'll get more information about what stock you're trying to trade. Most people just have access to level 1 screeners, and that's fine. You don't really get level 2 unless you pay a premium on that account. And the final thing I'm going to leave you guys off with is the Ringmaster. It is important to stay informed on financial news by watching CNBC, CNN, or reading Bloomberg, or just any news in general about whatever stock you're trading. However, do not trade just on news. Do your research. Amateurs trade on news. So as we've seen before, this person right here, they saw that they saw something on Twitter. However, they didn't do their own research. They didn't read the graphs. They didn't really have a strategy going into this, other than they had a feeling. And that's pretty much it for the first portion. So I'm gonna come out with multiple videos going into more detail, explaining basically everything that there is in this book. And like I said before, these are just my opinions. Take them with a grain of sand or a grain of rice, and actually read your material, do your research. And I'm not sponsored. Thank you very much for watching.